Hello everyone, I'm Shekhar from Momentum Lab. This is day 105 of my Momentum investment journey, building it in public. And so far, the portfolio strategy that I'm building has clocked the returns of 14.2% in absolute terms. So let's look at the portfolio performance and also the market review. And I also have a couple of interesting things to share. I'll be talking about that. So the first thing is that the portfolio is right now hovering at its all-time high within its all-time high range within that 5% from its all-time high band. Nothing much to worry. This is the NAV, and the red colored one is the Nifty 200. Nifty 200 has been making a slow up move, and whereas my strategy is right now hovering in that parallel band within this 115 range, and the drawdowns are also minimal as of now. So this is the scenario for last 1 week. I did not do the video yesterday because today, which is 15th of July, I wanted to do rebalance today because every first and mid of month, that is 15th, end of the day, I do rebalance. So I wanted to finish the rebalance and then do the video at one single shot. That's why I didn't do it on Sunday and waited for Monday. Now, coming to rebalance, there will be two stocks that will be getting exited, and I'll bet in two more stocks. Before jumping into those stocks, let me tell that I am not talking stock specific discussion anymore. You can look at my portfolio sheet, which is available in the YouTube description, and you can always infer what am I adding and what am I leaving. And you can also track in this exit sheet whenever I exit any particular stock, I enter here. And if at all I purchase a new stock, it is always in the XIRR sheet where you can track any new stock that I purchase will be mentioned against the date. This is the equity curve. Right now it is sitting at this levels, around 4.5 L. That's been the portfolio so far. There have been a couple of good performers in my portfolio. And right now the alpha is at 1.88, meaning we are overperforming or performing better than the Nifty 200 index by 1.88 or 188 basis points. And that is the case. And there have been a lot of suggestions from audience to compare my strategy against Nifty 200 Momentum 30. I'm sure I'll be doing that. But old habits die hard. So I've been accustomed to track with Nifty 200. So what I'll do is I'll add one more secondary comparison metric, Nifty 200 Momentum 30, and use this. Maybe I'll take UTI's mutual fund, which is tracking Nifty 200 Momentum 30 very closely. So that will be a very good comparison. And the next thing is the worst case loss in my portfolio right now is dwindling. It is now at minus 54K. So just to repeat, worst case loss is nothing but if at all my stocks exit because of the two criterion that I have. One criteria is it falls from its momentum rankings, the top 30 momentum rankings, or the second criteria is it falls below 20% from its 52-week high. Now, for the first criteria, like if it falls the ranking from the top 30, it need not necessarily be in a loss. It can be in profit, it can be in loss, and we'll never be able to quantify what that loss will be. The maximum loss that I can incur is when it falls by 20% from its all-time high. So what I do is I always calculate what is the distance between my purchase price from the 20% from its all-time high, and that I calculate as the worst case loss. Now, this worst case loss is the maximum that I can lose in any position. In some of the cases, you see that the worst case loss is in green, meaning that if at all the stock falls by 20% from its 52-week high, still I'm going to end up making money because my purchase price is much lesser than the 20% fall from the 52-week high. So the cases where it is not in green, it indicates that I'm going to incur a loss. So as you have seen that over a period of time, this worst case loss has been reducing, and now it is at a value of minus 54K. So meaning that if at all something bad happens, I might exit this strategy at a loss of 50K. So which is decent enough because on a portfolio of 30 lakh, 50K amounts to lesser than 2-3%, I believe. So that is a insignificant risk that I'm taking. Whereas if you compare with the net profit that I'm having, so the way I track is by portfolio heat. This simply is the ratio of the net profit that I am having divided by the worst case loss. In case the net profit is in loss, then the portfolio heat will be negative, or vice versa. When the worst case loss happens to be in positive, then it means the portfolio heat is in negative. Now, in all other cases, the worst portfolio heat is in positive or in green color. Now, let's say the worst case loss reduces even further and ends up being a positive number. Then what happens is that, as you can see, the calculation of portfolio heat, it is minus this value by this value, right? So what happens is it becomes a negative number, meaning I am not taking any risk. So that induces me or forces me that you can take more risk in your portfolio because you have a certain threshold to take risk. So I can take risk by two different ways. One is by reducing the uh, percentage fall from a 52-week high. Instead of 20%, maybe I can increase it to 25% or 30%. The other way, I can take more risk by topping up or adding more capital. If I don't want to add more capital, then the only way that I can take risk is by letting my portfolio consolidate, or letting my portfolio uh, bear the capacity of taking higher pains. Now, how can I take higher pain is by first ensuring that the percentage high from the 52-week high is not at 20% but at 30%. The other ways are reducing the worst rank held even further down. Maybe right now I'm holding 15 stocks and my worst rank held is 30. Meaning if any of my portfolio stock goes below 30th rank when I do the momentum ranking calculations, then I exit, right? If I can reduce it further from 30 to even below like 35, 40, or 45, then I have the capacity to endure even more pain. So those are some of the ways I can take more risk. By doing such actions of taking more risk, I have the probability to stay in the game for a longer period of time. Now, if you stay for a longer period of time, then obviously you will reap rewards in, like, whenever there's a fresh leg of up move or lesser number of transactions, and unnecessarily cutting down on losers quickly, and over trading, and all these things can be limited if I stay longer in the game. So that's the whole plan. Since I have the capacity to take additional risk, so I'm tweaking my portfolio construction logic a bit. Let me show you how I'm planning to do that right now. So let me first show what is the current logic that I follow. Right now, you see that I have a universe of Nifty 200, and from that I apply 5 different filters to come up with a list of stocks which are in uptrend. Again, on these stocks, I identify or I add 3 more metrics or signals to get the list of stocks. Now, if I'm already holding stocks, what I do is I also check the worst rank held. So in total, if you see, there are totally 1, 2, 3, 4, 5, 6, 7, 8, 9 different inputs that are going to create my portfolio. Now, ideally, I want to have as much lesser number of inputs or metrics to decide my portfolio, because if you have more number of metrics to construct a portfolio, then we might be overfitting the data, and the lesser number of inputs that we have to generate signals, the better is the output, and also it has a better propensity to perform better in the future as well. So let's just take a quick clone of this the current portfolio, and I'll show you what all I'm reducing or eliminating one by one. So the first thing that I'll be eliminating is I'll be removing this criteria of 100-day EMA greater than 200-day EMA, and I'll only be bothered about if the closing price is above 100-day EMA or not. So if the closing price of any stock is less than 100-day EMA, then I'm not interested in those stocks. So this will act like a market filter regime for whenever I'm filtering some of these stocks. And the second is 1 year return greater than 6.5%. I always want to keep this because this acts like an absolute momentum filter for me. And the number of updates in the last 6 months. Right now, I used to have a 50%. I'm now reducing it to 45%, meaning that some of the stocks, if at all they're undergoing consolidation, then they don't get filtered out and stay in the game. The next thing is stock must be within 20% from its 52-week high. I'm letting this right now because if I change this 20% to 25%, that is going to increase my worst case loss significantly. So I'll show you what happens. So let's say this is the worst case loss. Right now I have taken 0.8 or 20% from it, from its 52-week high. Let's say if I reduce it to 25, then it becomes 0.75. And then let me drag this to show the worst case loss then increases to minus 2.4 lakhs. So if I tweak this from 20% to 25%, I am staring at a potential worst case loss of minus 2.4 lakh or 2.4 lakh loss, which I'm not in a position to immediately take that risk. As time goes by, if I have more and more profits, then maybe I'll tweak this also so that I can withstand for a longer period of time using this strategy. So let me just quickly revert back. Okay. So this will be touched, but definitely not now, later. And then within these three also, 6-month returns, 3-month returns, and 1-month returns to calculate to construct a momentum portfolio. This, yes, I'll also be reducing the number of filters or the number of signals that I am taking to construct a momentum portfolio, but not right now. And the next thing is I am putting a very tight or not tight, or at least moderately tight threshold to exit stocks by keeping 30 as the worst rank held as of now. And you might have seen in my previous journey also that I was very diligent. Like whenever any stock crossed 30, I used to eliminate them because I wanted to run a very tight boat and ensure that I am making profit and I'm not steering at a steep loss. So I ensured that I always run a very tight ship. Now that I'm a little bit comfortable in terms of the profits and I have the leeway to take some risk, I'm now dropping some of these criteria so that I can ride longer. Same way, this also, the 30 stock worst rank hill, I am reducing it to 40 now, meaning even if the stock loses its momentum, but it's still in the top 40 rank, I'll still be holding this stock. So incorporating all these changes, I ran the Python code again, and we have the top 40 stock list. Out of these 40, two stocks have been eliminated because they were not in the top 40. Instead of these two, we'll pick two stocks from the top and be adding them into our portfolio. Now, this has been possible only because I had the capacity to bear additional risk. If I did not have any capacity to bear additional risk, the strategy would have remained the same. Now, as we see that going forward, if if at all I get in a better position of profits, then we'll slowly loosening up the signals or the inputs and be simplifying the overall momentum strategy further and further down. Now let's look at the markets. How are they doing? And then I'll show you a couple of interesting things. So let's go to the market caps once. Gold is seen to be very good because gold is performing well and it is also trying to make an all-time high again. Same is the case with the other indices. All of the indices are consolidating very tightly at these all-time high levels, like the micro cap. The last week there was one volatile session, but it quickly bounced back. It did not seem to be a big red candle because you see this wick, right? It indicates that there are a good number of buyers, and it is right now undergoing a very tight band. I could see that same thing in small cap, in mid cap, as well as in Nifty Junior. Nifty is the only index which has formed a doji kind of a pattern. If you remember, Nifty was behaving differently from the rest of the other indices when the other indices were consolidating. Nifty was moving up. Now, since Nifty has seemed to look like it has peaked, maybe it is time for other indices to move up in this week. So let's see how that happens. But all the indices are really good. They're all in proper order. Proper order meaning the closing price above the 21 EMA, 21 EMA above 50, 50 above 100, 100 above 200 EMA, and all of them making higher high and higher low structure in terms of chart rating wise. That's about the market cap. Now, if I come to the Nifty 200, Nifty 200 is also looking really good, but it also looks overextended from its 21 EMA. Maybe time for some cooling down to happen, but definitely they seem to be in a clear uptrend. So that is it about the portfolio and the markets. Now let me come to the next part and showing the momentum ranking of different stocks. Now, if you remember, I wrote a Google app script which fetches last 1 month, 3 month, 6 month returns, and then calculates its rank respectively, and then finally it calculates a final rank. Now, this was a cumbersome process because we had to run this script, and the script had limitation. It took some time, so we have to run that script multiple number of times to finally fetch the results. Now, this is a very simpler and easy solution which can be updated in real time. So let me show how it works. You have the stock name here. I listed down all the Nifty 200 stocks. And we have the today's closing price, which automatically gets updated real time as and when the ticker changes. And then we have last 1 month returns, last 3 month, last 6 month returns. And then we have 1 month, 3 month, and 6 month percentages. And then finally we have 1 month, 3 month, 6 month rank. And we finally calculate the final rank. Now, there is no refresh need to be done. This is a real-time data. It will always get refreshed automatically. All you need to do is just access this sheet and filter out by whatever rank that you want, maybe top 30, top 40, or top 20. And you can use it for discretionary or non-discretionary, or maybe you can use it for constructing your own momentum portfolio, etc. So the way it works is, it is very simple. First, we calculate the today's price by using the formula equal to Google Finance and the ticker, which is mentioned in the column A. This gives the current price as on day. The next thing that we do is we'll take 30 days before data. So what I've done, equal to today minus 30. And then we get the date for exactly 1 month before. That is 15th June, because we are recording this video on 15th July. The same way I did for 60 days and 90 days. Now, to get the price for 1 month back and 3 month back and 6 month back, we'll use this formula, which is equal to if NA in brackets, index, brackets, Google Finance, bracket, whatever sticker name is there, comma, the attribute, which is price, comma, the date, for which date do we want. Now, if you see that I have fixed the position of this ticker and the date. So even if you drag this down, this formula will not get affected. And comma 2, and comma with the blank. So what it does is, I'll try to break it one by one, so it becomes simplified. So let's first take Google Finance. If you just take Google Finance function, that is from this part to this part, let's see what it does. It basically gets you a tabular format of data. When I apply Google Finance specific ticker, comma, price, comma, particular date, it gives me a 2 by 2 matrix of date and close price on the first row. In the second row, you get the date and the close price. Ideally, we want only this value that is here. We don't want all this jazz. So to eliminate this, we'll use the index function. Index function, what it does, equal to index, it takes up the reference or the value that we want to pick up from a given matrix, which is in second row, comma, second column, which is in this matrix. This value is the second row and second column. So this index function gives the output of whatever is the um, particular cell that we're looking at. If you can identify what is that cell by given row and column, it will throw out. So it ultimately we get this value. If NA we are using, if at all there is any null values or no values available for this particular ticker, then it just discards by showing a blank value. So this is a simple function and very elegant function which compresses the entirety into one cell. And if you just drag this down, you will get 6 month, well, like 1 month back data. And same way for this for 3 month and 6 month. Again, this 1, 3, 6 month is just arbitrary. You can change these dates as you like. For example, if we change this from 30 to 360 to include, let's say, 1 year, then automatically this entire column, the values get changed. The moment these values get changed, the returns get changed. and the 1 month, this rank column also gets changed, because this 1 month is nothing but uh, the difference of the returns from today's price with respect to 1 month back price, and the rank is respect to for this particular column, in what position is this returns are, we'll get that column, and so on and so forth. So with this, we have simplified the tool, and I'll share this Excel sheet or Google Sheet link also in the YouTube description. You can, I'll give the view access. What you can do is you can click on file and make a copy. When you make a copy, you will get a file which is in your local, and you can edit this. You can always access the formulas and edit them if you. So this color coding also helps us to understand visually which stocks are doing good and which stocks are consolidating. So if you see a stock which is in green color, it means that it has a very good momentum. And if it is in red, it was not having that great momentum. So if, let's say, stocks which were really good 6 months back and slowly started to fall their momentum, you can see that in this fashion, like the latest 1 month will be in red, 3 month will be in lightish red, and 6 month will be in green. And vice versa also happens. Like if stock recently started to make an up move, then the 1 month will be in green, and the earlier months will be in red or dark red colors. I want to give credit for this solution to Mr. Ravichandran, who has been one of our subscriber, and he suggested this change or this idea instead of the app script. Thanks a lot. And yeah, I think that's all from my side. Let's catch up again next week.